What is manipulation? Manipulation is the act of artificially inflating or deflating the price of a security or influencing the behavior of a market for personal gain. Although manipulation is legal, it is fairly difficult to be noticed by regulators and other authorities.
How big investors manipulate the market? Now, there are diverse amounts of ways to accomplish the result of driving market prices into one's desired direction. The technique is quite simple and effectively works in the stock market. Let's take the example of the slingshot effect. Let's say there's a huge investor in hedge funds, mutual funds, or insurance companies. This large investor has a huge amount of control and purchasing power in the stock market. This investor decides to sell off a large amount of its stock in company X. As the large investor dumps the stocks, the price will naturally go down. As other investors notice this drop in the stock price, they may panic sell. This means that they will quickly sell off their own shares to avoid losing money. As a result, the stock price of the company X drops even more. Using the opportunity that the price is low, the large investor will buy large amounts of the stock again. This can cause an increase in company X's stock price. Seeing this, other investors will try to make a profit for themselves and buy shares as well. With more investors buying, the price of the stock will go up even more. The large investor then happily generates a large amount of profit for himself.
The pump and dump. With the internet, the pump and dump is fairly common. This usually targets small cap or micro cap stocks. This is illegal and, if caught, will be heavily fined. This is how it works. One investor tells other investors that she has inside information regarding company X. She tells them that the company X's stock price will soon increase. Other investors believe her and buy the stock. The investor then quickly sells all of her stocks when the price is driven up.
The poop and scoop. This is similar to the pump and dump. Let's say there is an informed investor that has inside information on company X. He knows that company X will soon receive great news which will drive the company's price up. However, he convinces other investors that the company is failing and the price will drop very soon. Other investors, believing his words, will dump their stocks and cause the stock price to go down. This informed investor then quickly scoops up the stock at a very low price. Several days later, the great news comes out and the stock price rides up, generating this informed investor a lot of profit.
Other methods of manipulating the market. One way to decrease a stock's price is by placing a large amount of orders for the stock at an extremely low price. When other investors see these low price orders, they'll feel like maybe there's something wrong with the company. As a result, they will sell their stocks, which will cause the stock's price to further decrease. This will be beneficial for the original investor. Another way to increase the stock's price is to buy and sell the stock at the same time. This will seem like there's a huge volume of orders going through for the stocks, which in order seems like a lot of people are interested in stocks. When other investors notice this activity, they will must buy the stock, causing the price of the stock to rise. However, these methods are not usually done alone. Most times, these methods of manipulation are also used with the spread of false information. These false information may be spread through online channels and messages that other investors look at. Overall, there are many methods that people use to manipulate the stock market. However, it is always important to note that these methods are illegal. Thanks for watching Animated Finance. Please subscribe and hit the like button.